So we learned about different type of legacies: specific legacy, demonstrative legacy, general legacy, and residual legacy. However, there might be some situation that there are not enough assets in the estate to satisfy all these legacies. And if anything like this happens, then the situation is referred as the process of abatement. And when we have to follow the distribution process, of course we will follow this order. That means specific legacy first, then demonstrative legacy, then general legacy, and at the end residual legacy. That means the chance to suffer most is for the residual legacy, for the abatement process. Now we will see one example. So let's take this example. A will states that the person mentioned that I leave 1,000 shares of AT&T to my brother. Since this is specific, we'll call it a specific legacy. And then he also mentioned he left his savings account at Chase Bank 20,000 to my sister. So this is a cash gift and the source is identified. It's a demonstrative legacy. And then 40,000 cash to my son. It's also a cash gift, but the source is not identified. So we will call it a general legacy. And then all remaining property will go to my daughter. That means daughter is here, will get the residual legacy. Now let's see what happened. So first we will also pay all administrative expenses, medical bills, all claims, debts related to the property, and after meeting all these obligations and claims, we have to follow the payment procedures. And after paying all claims, we found that the estate holds the AT&T stocks, and then the estate also does have 20,000 Chase Bank savings account and 75,000 in other cash. So what will happen? Of course, the specific legacy is met. The brother will get all AT&T stocks, and then Chase Bank also has 20,000 savings account cash that will go to sister, and then the other cash is $75,000. So out of that 75,000, the son was gifted 40,000 cash, general legacy. The son will be paid 40,000, and the remaining 35,000 will go to the daughter. So the scenario is very beautiful because the estate does have enough assets to meet up all legacies. Now we will see the same example, but after paying all claims, the estate might have different amount of property. For example, the estate does have the AT&T stocks. Chase Bank savings account is also there, but the other cash is only 35,000. Then how it will be distributed? So the specific legacy will be made because there are the AT&T stocks that will be paid to the brother, and Chase Bank account also has 20,000 that will be paid to the sister. But this time if you look at the general legacy, which has a priority before the residual legacy, the son will receive $35,000 cash and the daughter will receive nothing, because first we have to make general legacy, and if anything is remaining, that should go to the daughter. Here the daughter is suffering most. The residual legacy got nothing, and even the son, he was mentioned to give 40,000 cash, but he will be given $35,000 cash since there is not enough assets to fulfill these legacies. Now we will see the same example, but this time the estate does have AT&T stocks. Chase Bank only has $12,000, not 20,000, which was supposed to give to the sister. And then other cash, there are some other cashes, and that is $51,000. So now how we gonna distribute it? So the AT&T stocks are still there, so that will be given to the brother. And then look at the Chase Bank account. Chase Bank only has $12,000. So first the sister will be given this $12,000, And then later we will see these other cash $51,000, which is a general legacy. And here we know that the son is entitled to get $40,000. So here out of these $51,000, the son will be given here $40,000. And then how we gonna distribute this $11,000? Well, it varies from state to state. Some state may treat this 11,000 as a general legacy, and you also remember that for the demonstrative legacy, the sister is not paid up to 20,000. So some state may require that the sister will be given here the rest of the 8,000 from these $11,000, and then here the residual amount 3,000 will be given to the daughter. Now we will see a different example. Say the person actually sold all the AT&T shares before his death, and then after paying all claims, the Chase Bank account holds $23,000, and there is also like other cash amounts, $30,000. Since the brother had a specific legacy which was specifically mentioned related to the AT&T stocks, and those were not there after the death of the person, the brother will get nothing. Now Chase Bank had 23,000 and the sister will get 20,000 out of it because it's a demonstrative cash legacy and the source was identified and that source had enough cash to meet up that legacy. Now here from the Chase Bank account there will be remaining $3,000, and here also we do have in other sources $30,000. So these entire $30,000 will be treated as a general legacy and the son will be given that $33,000. Remember, the son was entitled to get 40,000, but he is getting 33,000. Since the son didn't get up to 40,000, so there is no remaining property or residual amount to pay the daughter who was supposed to treat it or get as a residual legacy. Now here we will learn about some other terminologies and we will also learn about the principal and income from an estate. There might be some situations and the executor may face some problem to differentiate between the income and the principal transactions related to an estate. For example, a will might say that all income earned on my estate for 5 years after my death will go to my sister, and then the estate will be conveyed to my children. So it becomes complicated. So the executor must need to differentiate the income and the principal. The recipient of the income is known as income beneficiary, whereas the party who ultimately receives the property or the principal is known as the corpus or also known as remainder man. So here some cases or some other type of expenses that easily cannot be identified or categorized either as principal or income, such as funeral expense or executor's fees. Although there are different type of regulations in different states or there might be different provisions of a will, there are some common items or transactions that can affect the principal of the estate. That means the principal of the estate can increase or decrease because of these type of transactions. For example, life insurance proceeds or dividend declared prior to the death or any other income earned prior to the death, liquidating dividends, debt incurred prior to the death, gain and losses on the sale of corporate securities or rental property, or if there needs any major repairment or improvement to a rental property, investment commissions and other costs, funeral expenses, homestead and family allowances that is paid to a spouse or minor children or dependents, and these type of transactions will affect the principal of the estate. Now, here the income of the state actually includes all revenues and expenses related to the property and that happened after the death of that person. And there are some items that can affect the income of the states or that can increase or decrease the income of the state. Most cases, it will reduce the income of the states. For example, payment of real estate tax or any other personal property tax, or if there will be a need of very minor repair expense, water and other utility expenses, insurance expense, and other ordinary expenses. Now we will learn a little about trusts. So a trust is created by the convenience of assets to a fiduciary or trustee who manages the assets and ultimately disposes of them to one or more beneficiaries. The trustee may be an individual or an organization such as a bank or other financial institution. Over the years, trust funds have become very popular. There are several reasons why. It actually reduces the size of a person's taxable estate, and it also provides guideline how the will be executed and the distribution of the property will be properly maintained. It also protects the assets and ensures that the eventual use of these assets as it is intended. And I also mentioned earlier that the trustee can be an individual or an organization. Now we will learn some legal terms related to trusts. So if a trust is established while a person is still alive, it is called inter vivos trust. On the other hand, if a person mentions anything in his will that there will be an establishment of the trust to distribute the property, then it is called a testamentary trust, which is established by the will after the trustor's death. The person who funds the trust is called the grantor or trustor or settlor. The person who funds the trust appoints a trustee to manage the investment of the trust. Now we will learn different type of trusts. One most common trust is known as revocable living trust. So this trust is obviously is established when a person is alive, and the trustor usually manages the trust and the fund and receives some incomes until his or her death. And it is also known as revocable. Why? Because revocability means that the trustor can change beneficiaries or can change any terms anytime before his death, and it avoids delay and expense of probate, and it also allows privacy. Remember, wills are public documents, and the probate court will validate the specific legal status or the requirement of a will. On the other hand, trust can be maintained privately. At the trustor's death, the trust continues and makes future payments as defined in the trust agreement. We will learn different type of trusts. For example, one common type of trust is credit shelter trust, which is also known as bypass trust or family trust. It is usually designed for couples where each spouse agrees to transfer at death an amount of money to the other. Then another example is qualified terminable interest property trust. Here property is conveyed to a trust, distributions are paid to the beneficiary, and it allows steady income for one beneficiary while protecting principal for another. Another common type of trust example is charitable remainder trust. Here trust income is paid to a beneficiary for a specific time period, and then the principal is given to a stated charity. On the other hand, charitable late trust is just the opposite, where trust income is paid to a specified charity for a specific time period, and then the principal is transferred to a different beneficiary. You will see few other examples of trust. For example, grantor retained annuity trust, where trustor collects fixed payment from the trust and then principal is given to beneficiary after a specified time or at the death of the trustor. Then you will see few other examples: minor sections 2503C trust or spendthrift trust, irrevocable life insurance trust. Here, irrevocable life insurance trust, money is contributed to purchase life insurance on the donor so that the proceeds can be used to pay estate and inheritance taxes. And another example you will also see: qualified personal resident trust. Here, donor's home is given, but the donor retains the right to live there for a period rent-free. Trust accounting is similar to state accounting, but it can be a little bit complicated, and it's always difficult to differentiate the principal and income and how these will be affected. Sometimes some provisions or directions may not be covered by the trust agreement, and then we have to check with the state law. And we will also remember that GAAP, or the generally accepted accounting principle, may not be applicable for trust accounting, and usually trust actually follows the cash basis accounting, not the accrual basis.